Welcome back to The Explainer. Today, we're taking on a huge topic, completely demystifying Nigerian value-added tax, or VAT. If you're running a business in Nigeria, you know exactly what I'm talking about. Honestly, understanding this isn't just about checking a compliance box, it's an absolute survival guide for your entrepreneurial journey. We're going to break down all that dense, headache-inducing legal and accounting jargon into clear, actionable steps so you can confidently tackle your tax obligations.
Okay, let's dive right in. Right off the bat, we need to anchor ourselves to a very specific number, and that is 7.5%. Thanks to the Finance Act of 2020, 7.5% is the standard VAT rate in Nigeria on all vatable goods and services. And who runs the show? The Federal Inland Revenue Service, or the FIRS. They're the ultimate boss when it comes to assessing and collecting this tax.
So, to make all this digestible, we're going to follow a really clear 5-step roadmap today. First, we'll cover the basics of Nigerian VAT. Second, we'll look at the 25 million naira threshold. Third, we'll figure out what's vatable, exempt, or zero-rated. Fourth, we'll tackle calculating input and output. And finally, number 5, penalties and dispute resolution.
All right, let's hit Section 1, the basics of Nigerian VAT.
You know, a lot of people think VAT is just a one-time tax slapped onto a product at the very end of the line, at checkout. But actually, scratch that. It's a multi-stage consumption tax. What that really means is there's this chain reaction happening at literally every single step of a product's life cycle, from the manufacturer buying raw materials over to the wholesaler, down to the retailer, and finally to the end consumer. The tax is collected at every stage of production, sale, and service delivery. It's like a giant puzzle where everyone holds a piece.
Moving on to Section 2, the 25 million naira threshold.
Okay, picture this timeline. Say you launch your brand new business in month 1. Things are going great, and by month 3, boom, your taxable revenue hits that magic 25 million naira mark. According to the rules, your legal obligation kicks in right then and there. So by month 4, you must start charging your customers VAT, collecting it, and then remitting it to the FIRS by the 21st day of the following month. If you hit that 25 million threshold at any point in the calendar year, the clock officially starts ticking for your monthly returns.
But hold on, there are some really important nuances here. While 25 million naira of taxable supplies is the trigger, not all money coming into your bank account counts toward that number. For example, if you sell capital assets or sell off your actual business, that's totally excluded from the calculation. However, and this is a big however, if you're an upstream petroleum company, you don't get a pass. You're required to withhold VAT even if you haven't hit the threshold or even officially started commercial operations yet. Oh, and for the smaller businesses out there, the law actually lets you voluntarily register and opt in before you ever hit that 25 million mark, as long as you notify the FIRS.
That brings us to Section 3, vatable, exempt, or zero-rated.
Before you can calculate anything, you got to know if your product is even taxable in the first place. There's a vital comparison we need to make right here between exempt goods and zero-rated supplies. Now, for the everyday consumer, both of these just mean they don't see a 7.5% charge on their receipt, but legally, completely different beasts. Exempt goods are entirely outside the VAT net. We're talking medical products, basic foods, educational materials, baby stuff, and commercial or residential rent. Zero-rated supplies, on the other hand, are technically inside the VAT net, but the rate applied is literally 0%. That applies to things like non-oil exports, goods for diplomats, and humanitarian donor-funded projects.
So how exactly does the FIRS define goods? Basically, it means all forms of tangible properties, whether they are movable or immovable. But look closely at what's excluded. Land, buildings, money, and securities are specifically left out. This is absolutely crucial, and it's actually been the center of past tax tribunal disputes, which, fun fact, is exactly why rent on real property was officially declared exempt.
And what about services? Well, the definition here is incredibly broad. A service is basically anything you provide to someone that isn't a good and isn't provided under a standard everyday employment contract. It even includes intangibles and incorporeal assets transferred between people. Basically, if you're consulting, designing, or providing any kind of professional skill outside of a regular salary arrangement, yep, you're providing a service in the eyes of the FIRS.
All right, take a deep breath because we are now entering the boss battle of the explainer. Section 4, calculating input and output. So the crucial point is understanding these two terms, starting with input tax. Put simply, input tax is the tax that you, the business owner, pay to your suppliers when you buy taxable goods and services. Think about it like this. When you buy raw materials to make whatever it is you sell, that 7.5% you pay your supplier, that is your input tax.
On the flip side of that coin, we have output tax. This is the 7.5% tax you collect from your clients or customers when you sell your taxable goods or services to them. Honestly, the relationship between these two, the tax you pay out to suppliers versus the tax you collect from customers, is the whole secret to mastering VAT.
And that brings us to the absolute fundamental formula of this whole system. Output tax minus input tax equals your VAT liability. It's that simple. If the tax you collected from your customers, your output, is greater than the tax you paid your suppliers, your input, you owe the FIRS the difference, and you have to remit it by the 21st of the following month. But get this, if your input tax actually exceeds your output tax, you are legally entitled to a refund of that excess money from the FIRS.
Let's look at a real-world example to make this concrete. Let's track a product from Ola BC Limited as it moves down the supply chain. First, the manufacturer sells to a wholesaler for 2 million naira, charging 150,000 naira in gross VAT. Since they're the start of the chain, they remit that full 150,000 straight to the FIRS. Next, the wholesaler sells to a retailer for 3.5 million naira, charging 262,500 in VAT. But remember our formula. The wholesaler deducts the 150,000 they already paid as input tax, so they only remit the net difference, which is 112,500, to the FIRS. Finally, the retailer sells to the end consumer for 4.2 million, collecting 315,000 in VAT. They deduct the 262,500 they paid the wholesaler and remit the net 52,500. Now, if you add up the net VAT remitted by all three stages, 150K plus 112.5K plus 52.5K, the FIRS gets exactly 315,000 naira, which just so happens to be exactly 7.5% of the final consumer price. It's honestly pretty brilliant how the burden is seamlessly shared across the whole chain.
Now, what's really interesting about this next part is the strict limitations the law puts on you. You might be sitting there thinking, awesome, I'll just deduct all the VAT I pay as a business from what I owe. Yeah, not so fast. The law strictly limits input tax deductions to goods purchased directly for resale or materials that form your actual stock in trade. You absolutely cannot deduct VAT paid on your general overhead, admin services, or capital assets like heavy machinery. For those, your overhead VAT costs just have to be expensed in your profit and loss statement, and capital item VAT has to be capitalized right along with the cost of the asset itself. No double dipping allowed.
Which leads us to our final leg, Section 5, Penalties and Dispute Resolution. We gotta talk about the stakes here, because the FARS treats non-compliance incredibly seriously, and the financial penalties are no joke. If you fail to register for VAT when you're supposed to, or if you fail to submit your returns, you get hit with a 50,000 naira penalty for the very first month, and then 25,000 for every single month after that. If you submit returns but fail to actually remit the money you owe, there is a flat 10% penalty on the unremitted amount, plus interest charged at the Central Bank of Nigeria's minimum rediscount rate. And here's a really heavy one. If you fail to issue a valid tax invoice for the goods you sell, you're liable for a fine equal to 50% of the cost of the goods or services themselves, half the cost.
But hey, it isn't completely one-sided. There is a safety net in place, and it's called the VAT Tribunal. This is a dedicated legal body set up geographically across the country. If you get an assessment or a demand notice from the FIRS that you fundamentally disagree with, you have a legal right to appeal it. But you gotta move fast. You only have 15 days from the exact date you receive the notice to submit your appeal in writing to the tribunal.
And that brings us to the end of our journey through the tax code. We've seen how VAT chains together step by step. We've broken down that critical 25 million naira threshold, explored the strict rules on deductions, and looked at those heavy penalties for getting things wrong. So, I want to leave you with one final, provocative thought to chew on today. Based on everything we've just unpacked, is your business fully VAT compliant, or are you sitting on an expensive ticking clock? Seriously, do yourself a favor and take a close look at your books today. Thank you so much for joining me on this explainer. Keep learning and stay compliant out there.